name's Kevin French from Core Wealth. We welcome you to 2022. What we're going to be doing in this wrap-up is just having a look at 2021 and the year as a whole in terms of financial markets, and then having a look ahead at some of our expectations for the new year. So if we look back at 2021, what were the big things that stood out globally in the news? There really were three that we'd highlight. One is obviously Corona and its impact both on economies and still on people's lives. And we're seeing the numbers that are coming out. Those that haven't been vaccinated are ending up in hospital and still even passing away. So it's still important that vaccines get rolled out. And then the other thing that we're seeing, particularly in the developed world, is where people are contracting the virus and then having to go into isolation, and its knock-on effect on economies, people not being able to go to work, etc. If we look at economic growth last year, however, it wasn't bad. It was around, we were expecting the number to come out at around 5.6% growth in the global economy. A lot of that is catching up from what was lost in the previous year, but still a good year, and that's with the economy not firing yet on all four cylinders. The second thing that was a big news story was inflation, particularly in the developed world and especially in the US. US inflation, the last number that came out was showing a 7% inflation. Now this is a country that's used to having inflation below 2% even. And these numbers are similar to what you saw back in the early 80s. And this could have a knock-on effect, and it's still a big question in 2022 because it could force the American government or the Reserve Bank to raise interest rates. The last thing was just in China, big news around property and property developers in China, one of the biggest in the world, a company called Evergrande, basically insolvent, and that caused big ripples in the markets, especially in emerging markets around the latter half of last year. Now if we have a look at the same thing for 2021, but just looking at the South African news, there were a few things that stood out. The first one was the size of the South African economy. There's every 5 or 6 years there's a revision of the measurement methodologies, and it was found that the South African economy is about 11% bigger than they'd previously been measuring. And that's obviously a plus to see that the economy is bigger than was thought. The second one was just the level of economic growth last year. Now, while the third quarter economic growth actually came out worse than expected because of the riots that happened in KZN and parts of Gauteng, despite that, we're still expecting economic growth to be in excess of 5%, possibly as much as 5.4% for 2021, which is a really healthy growth, and this was on the back of good agricultural markets and farming crops, and also on the back of rising commodity prices which benefited the mining sector. The third major highlight that we saw last year was right at the end of the year, and it didn't receive much media coverage, but the rating agency Fitch, which analyzes whether South Africa is a good place to invest or not, came out with an improvement in the outlook. And previously we'd been on a negative outlook, and this was upgraded to stable, which is again just further signs that things are improving and would be good for foreign investors looking at South Africa. The last point that we saw a fair bit on actually last year was the improvement in structural things around the way South Africa operates. Things like South African Airways being privatized. It now has a private shareholder, and this can only be good in terms of improving how it was being operated. Things like private companies now being able to generate their own electricity. So big concerns can effectively build their own mini power stations so that they don't have to worry about fluctuations in electricity supply from Eskom. Then on the corruption front, we saw things like Zweli Mkhize having to step down and huge investigations going on there. Ace Magashule being essentially fired as the Secretary General of the ANC, and of course Jacob Zuma ending up in jail. Now there's still lots more to come, and just before recording this we've seen the release of the first phase of the Zondo Commission's report around state capture, and these are all bits that we think are going to add further tailwinds to the South African economy. So if we have a look at what the markets did last year, starting with December, it actually was a great end to the year. We saw global markets up almost 4%, the South African equity market was up almost 5%, and listed property in South Africa up almost 8%. The only area where things were a little bit muted was in emerging markets, up just 1.5%, and then obviously cash. Cash has not been the place to have been in 2021, and if we have a look for the last year, you only earned around 3.8% on cash, which is lower than what the inflation was for the year. But other markets you did really well. If you had an offshore portfolio, your performance was over 32% for the year. Emerging markets struggled, and some of that was on the back of what I mentioned earlier around China, up only 6 odd, or just under 6%. The South African equity market giving you over 29%, and South African listed property being the best performing sector in the ones that we're showing here, of almost 37% for the year. The bond market was up okay, it was up only 8.4%, but I say only, that's comfortably ahead of inflation of 5.5% for last year. If we just have a look at a bit of the longer term picture, you would probably recall me saying in earlier videos how the medium term picture for particularly South African equities was below long-term returns. And what you can see now, if we have a look at the JSE, for example, the 3-year number return of almost 16%. The 5-year number is still a little bit lower than one would expect, because of what we saw for almost a 5-6 year period under Jacob Zuma's time, where equity markets were very, very soggy. But we are seeing the longer term returns starting to pick up, and they're all healthily in double-digit returns now. On the global side, if anything, the 3 and 5 year numbers, 10-year numbers are exceptionally high. To get real returns of almost 15% is higher than one would expect over longer periods of time. So we may see that be tempered a little bit in the coming years. Listed property still negative over 3 and 5 years because of the big knock that it saw, and that's the strong returns we've seen over the last year to 18 months has been because of those markets starting to catch up and make up for the losses that they saw. So if we have a look now at how our portfolios for clients did over last year and longer term, we'll start with the global portfolios, which now have been running for over 5 years, the dollar-denominated ones, and we can see December was a good month. Portfolios up quite nicely in hard currency terms. Over the last year, the numbers in brackets in this slide just indicate how the portfolio is done relative to its peers, so other similar type portfolios. And we can see over the last year, good for our defensive and balanced strategies. Our more aggressive strategy underperformed slightly over the year, and that was really just because of a higher overweight to emerging markets. But what's most important is that 5-year number. These are all long-term portfolios, and we can see all of them delivering some healthy outperformance versus peers, so the amount, the portions in brackets. And then secondly, the absolute return is also very, very attractive. And remember, these numbers are already in US dollar terms. So quite happy with the way these portfolios are performing, and has benefited our clients with our offshore clients and our clients with offshore assets. So if we have a look at the South African portfolios, December was a great month. You'll see all the portfolios up quite nicely during that month. And if we have a look at the year of 2021, again, another good year, both in absolute terms and particularly in relative terms. We saw strong outperformance across the board of all our portfolios. Probably especially pleasing was our income strategy, generating some strong outperformance, and really in a period where cash has not been the place to have been, this more conservative strategy is ideal for investors who want to keep some cash in their portfolios and still get a return that in this case was better than inflation. and then some of our more aggressive strategies increasing by almost 25% during the year, which was really healthy. If we have a look over the longer term and since inception numbers, now not all of these portfolios started at the same time, so it's not something that you can really compare the one to the other one necessarily. You'd have to look at our fact sheets one by one to do that comparison. But quite happy with the long-term outperformance. You'll notice that our two recurring income strategies, the RI Defensive and RI Growth, are slightly behind their peer groups, and that's mostly because the peer groups are actually not that comparable. It's a very broad peer group, whereas these strategies are quite unique and focused on generating income out of a growth portfolio. So if we have a look ahead globally, there's a few things on the horizon. The biggest one is what is going to happen with inflation. Now, the slide that I'm showing you now will show you how inflation has picked up both in the US and in other countries around the world. The risk when inflation picks up is that interest rates then rise to try and dampen the effect of inflation. And the next slide that I'm showing you is what they call the dot plot from the Federal Reserve in the United States. And each dot is a member's vote. So you can see in 2021, all the members were at the same point, expecting interest rates at that level. In 2022, we can see the bulk of them are in fact, they're all expecting to raise rates, but the bulk of them are expecting interest rates to rise by about 0.75%. And then in 2023, a further increase as well. This is generally negative for what we call growthy type stocks. So stocks that generate very big profits but don't necessarily have big assets in their portfolio. And technology stocks fall into that category. And so the NASDAQ is a stock market in America that is predominantly technology stocks. And from this graph that I'm showing you now, you can see that as interest rates rise, we can see that the NASDAQ actually falls usually when interest rates rise. And so we would expect technology stocks to perform less well into the future. But historically, if you have a look at more valuation-driven companies, as interest rates rise, they tend to outperform. And this is something that we're expecting to see happen over the coming years in both global stock markets and even in South Africa as well. If we have a look at the South African economy and South African stock markets, firstly, the economy is projected to grow at around 2.5% in 2022. Now that might not sound that high, but to give you an idea, that's more than doubling, in fact getting close to almost 3 times what it was in the 5-6 year period prior to COVID. That's obviously a positive. However, we do have high unemployment, we do have still some structural challenges in terms of things like Eskom, the way the state-owned enterprises are run, and those are still drags on the economy and hamper us from growing as fast as we really need to. However, it is a vast improvement from what we saw in prior years. The other thing that we see in the South African market is that the valuation on our shares, the companies listed on the South African Stock Exchange, still are very attractively priced. So if we add this improvement that we are seeing, although we're not there yet, in the overall economy, that's good for businesses, and businesses start producing more and start making more profits. Plus you can buy those companies at quite attractive valuations. Add to that we think that because of what's going to happen globally in terms of interest rates, there'll be further demand for emerging market stocks, and that would be a further tailwind to the South African stock market. So 2021 was a really great year for markets. We look ahead at 2022 and we see a number of opportunities there. There are some things that are worrying in terms of interest rates rising, which could affect your more growth type stocks and particularly US tech stocks, but enough opportunity in diversified portfolios to make the most of 2022. We're back at work now and look forward to seeing you this year, whether it's in our offices or whether at some of the events that we hope to be having in person as Corona dissipates in the year.